Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk, our weekly review on Friday, 5th of December, 2025. This is where we break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead. We'll try to give you a heads up on what you should be looking out for. Today, I'll be joined by Sam Cutler, Portfolio Manager at 333 Capital. He'll help me make sense of what we've seen and what's likely to matter next week. But before we start, just a quick disclaimer. The content provided on this channel is for educational and informational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with all the legal stuff out the way, a warm welcome and Merry Christmas to Sam. Sam, how you doing?
Hey Harry, I'm good, man. Feels like it's been a while since we've chatted.
It probably has, actually. It's probably been a good month or so. For reasons we can go into at a later point. But again, the past 2 weeks have been relatively dull anyway. So, well, in certain circumstances. But we want to look at what's happened over this past week, given that nice little trailer. We've just had data out that we want to talk about in the form of the personal spending, personal income PCE data that's hit the wires just now alongside University of Michigan prelim for the month. In terms of the PCE, we'll take a quick look at that as we have just seen that really. And there wasn't too much, I don't think, in it for us to sort of get our teeth into. Month over month, core PCE came in for September at 0.2%. That was in line with forecasts and last. The year-over-year reading, which everyone looks at, 2.8%, again, in line with estimates and 10th down on last month. Headline PCE price index on the month was up 0.3, as expected, as last. And the year-over-year headline at 2.8, again, in line with expectations and a 10th higher than we saw the previous month. Now, obviously, the caveat to all this is September data, and therefore it leads into my question: is this too stale to be taken seriously? I said we had University of Michigan data out as well. Just a quick look, just for bookkeeping's sake. What do we see from that? So, University of Michigan sentiment prelim rose to 53.3 from 52 expected after 51 last time round. That one-year inflation gauge was 4.1. That eased from 4.5 last month and 4.5 expected. The 5 to 10-year inflation was at 3.2 from 3.4 expected and last. Current conditions were at 50.7. That had softened from 52.1 expected and 51.1 last month. And just quickly, expectations were at 55. That rose from 51 last month and 52.7 expected. Right. With that, let's get back to that the headline piece then. US Core PCE, is this too stale to be taken seriously? I think I know your answer to this one, Sam. So what do you think?
Yeah, I mean, I think it's definitely stale. That's why it's almost 2.5 months old now. I think, it would have had to have been a massive surprise to either side to actually get anyone to look at it. It was, once we got the PPI and CPI from September, it was pretty easy to calculate this. I think the unrounded was supposed to come in at like 22 basis points for the core metric, which I think is exactly, what it came in at. We did see, as expected, kind of a little bit of a slowdown in goods. But the only thing, that I'm kind of paying attention to is kind of the healthcare component of all these things. And even though it is stale data, the healthcare component, the inflation is kind of sticky there. And I think this is something you really want to pay attention to as we go into next year, because I think this could be a problem. It's an inflation worry going into 26 because of the Obamacare subsidies. They run off in early 26. So if there's no extension on this, I think you're going to get a little bit of a kind of sticker shock on some of these healthcare costs. We'll call it, especially since we're running kind of this K-shaped economy. Those at the bottom of the K are going to kind of suffer a little bit from that. And the only other thing, the personal income, personal spending, the prior months were revised down a little bit as well. That kind of caught my eye. So, that's kind of it on this. There's not much I can draw from it. The only thing is moving forward is, I have a close eye on kind of this healthcare inflation into early 26.
Okay, good to know. So let's look at slightly more prescient data then. We saw ADP private payrolls out this week as well, along with other bits and pieces of job data. This was the monthly read, so we didn't get a weekly look. Has this cemented a December cut in your eyes? It was a low figure compared to expectations. Actually, it was minus, wasn't it? We came in with losses as opposed to a small gain expected for the ADP number. Let me just if I can get the data up, let me find out.
Yeah, it was down. It came in down 32,000 versus what the consensus I think was around a gain of 40K.
It might be slightly less than that, but yes, in fact, he was looking for a gain.
Yeah, so it was a pretty, still pretty big miss. But I mean, look, if you look at kind of the range of estimates on something like ADP, like the bell curve is insanely wide. So it's something difficult, but it's more kind of looking at within the numbers, right? And there was definitely, if you look within the report, right, there was definitely some weakness, but it was concentrated mainly in small businesses, right? Small businesses shed 120,000 jobs, while the large businesses added 90,000 jobs. So again, a lot of pain in that, smaller side of the economy, the small businesses. And the only other thing really that stuck out there was, wage growth also decelerated to 4.4%. I believe it was. And there was a couple other things in regards to labor, right? Since the government has been shut down and we haven't really got NFPs, there's been a lot of this alternate data stuff, right? And what is it? Revelio Labs is another one that has come in, and these came out yesterday along with jobless claims, right? The initial claims came in so low. I think it was like the lowest level since September of 22. But again, the move in these claims is also very distorted by the seasonal adjustments around the Thanksgiving holiday, right? So you look at a couple other things too, like war notices, right? War notices declined. So we're still kind of, the data still is pointing to no one's getting hired, but no one's really getting fired.
Okay.
Right. So we're still kind of just in that hiring freeze. And if we're looking at the Revelio numbers from yesterday, right, they're kind of NFP data. I'm saying I'm doing air quotes as I say this, by the way, came in at, negative 9,000. You saw a slight gain in government jobs while private jobs posted a loss. Right. So the biggest decline there came from leisure and hospitality and retail trade. So, maybe attribute that to some of the holiday stuff. I don't know, but education and healthcare were the ones that gained the most alongside government. So I think, people look at these now just because we've been, kind of in that BLS void, and now we're not even going to get the October numbers because it wasn't collected. So I think everyone's kind of just been grasping at straws. And I think at the margin, the last employment report we got for September with the tick up in unemployment, I think that kind of did cement the cut next week for the Fed. But other than that, we haven't really seen too much with the labor market. It definitely slowed. And the point now is just has it hit a little trough and going to recover a little bit? And unfortunately, with this government shutdown, I don't think we're going to get start getting cleaner reads on the economy on the jobs front until January, February.
Yeah, no, I think that aligns with what other guests have said and what we've experts are writing at the moment, really on this front. So with it so still foggy in terms of data, in your opinion, would you be cutting in December based on what you haven't seen, or if you're a Fed member, for example?
Look, I mean, it's so hard. I think it's I think it's a mistake. I think there's going to be some inflationary pressures into the first quarter of next year. Just from fiscal standpoints as well. If some of this healthcare stuff doesn't get revised, you're going to see healthcare inflation a little bit more persistent as well. It's tough though, right? And I think the economy is very difficult right now, especially because we're clearly in this K-shaped economy where the bottom shape of the K is suffering, right? And the upper part of the K is thriving, right? Equity markets are doing okay, and I think that's kind of changed the realm here, right? Before, you used to get a recession, which would cause kind of equities to sell off. I think right now, in order to actually get like a severe deterioration, you're going to need stocks to sell off before you get kind of any recessionary data, just because of that upper part of the K, is so invested in the market, and everyone's making good money, so they're continuing to support spending.
Okay.
So I think it's a really, really tricky scenario here. I mean, if you look at the US, the 1-year rate's been, I think hovering right around that 3 to 3.10 area, which I think if you look at, market pricing, we're expected to get, down to the lower 3, late summer of 26. So it's a tough one to judge, right? Like I see the risks to both sides. I'm glad I'm not the Fed chair and has to make this decision. But I think
if you're unsure, you don't do it. Surely, if you're unsure, I mean, this is your opinion, but if they are unsure, why are you doing it? We saw the minutes of the last October meeting. They were very divided in the October rate decision, and that came through in what we saw. And it appeared they were still decided. They were undecided on October, or divided on October. They were still divided on December at the time. Now, obviously, we've had bits and pieces of data out since then, but like you said before, it's all backward looking. It's fairly stale.
Yeah, and I think still they could even use that as like, I mean, look, if I was, if the decision was on me right now, I wouldn't be cutting rates, and I'd just be using the excuse, hey, we're kind of flying still in murky waters. The government shutdown caused, delays of data. We don't have a clear view on it now. We're going to wait a couple months and see. And that keeps us open for January, keeps us open for March. But, we're not really committing to any path right now till we get a better read. That's what I would do. But, again, it's not that simple.
No, it's not. But I mean, it's kind of what Powell said at the last meeting, and has subsequently said, emphasizing that inflation remained above the 2% target, where progress was evident, but did stress no pre-commitment to further cuts. We've had other Fed officials. Obviously, we're now in the media blackout period, so we haven't heard anything since last weekend from any official in any monetary policy sense or economy sense. John Williams has said there is room for further adjustments. Waller, who's a dove anyway, has come out and stated that after months of labour market weakening, another cut was in order. We know what Myron's about, really. And Bowman was leaning dovish, if I'm right in what she's been saying of late. So, there are reasons to think. I mean, I still thought the December cut was coming even after the October meeting, but the market seemed to flip, and it's subsequently flipped again. So what do I know on that front? We'll come back to the FOMC in a minute because we'll look at it because it's a next week event. But just quickly rounded off the week, we saw Eurozone CPI flash reading, not a lot to see there, I think 2.1% on annual print. The ECB, again, they seem stuck in a holding pattern at the moment. Do you look at that in any meaningful way at the moment?
Yeah, I think the Eurozone's pretty straightforward right now, right? I mean, inflation is pretty anchored here. Year over year is right around their 2% target. The only thing that stands out is kind of the service inflation rising to 3.5%. So, that still kind of shows some persistent underlying price pressure. So I think it's unlikely, you see any further cuts from the ECB in the near term. And I think, that just presents, for me personally, that's just been kind of a trade I've been doing is, trading, I'm a little more bearish on the UK economy here. So, just trying trading some UK rates against, the Eurozone rates here. I don't think there's going to be too much happening there. And, nothing is signaling that they need to, cut interest rates further there.
In the Eurozone, yeah. But for the UK, I mean, yeah, you and everyone else is worried about the economy. I think we've priced back in for the UK. They're pricing back in a cut this month now, and potentially one more in March. If I read the room.
Yeah. There's one. I think December is pretty much a done deal, and then there is another one in the first half of next year, and I could see that possibly getting pushed to 2 cuts in the first half of next year.
Yeah, I think some of the growth forecast a little bit optimistic. Okay, let's turn to the week ahead then, really, and headlines with the FOMC as we come into the. And I've got a question really for you about how you treat December generally. As someone who manages a portfolio and everything that goes with that. But we've covered the FOMC interest rate decision. We're expecting them to cut rates then by 25 basis points, and then. Looking to the future, do you still think they'll message anything other than, based on what we've just discussed? We've got our personal views, but do you think they'll make any kind of signal towards the early part of next year, or do you want to leave that gate well and truly open?
I mean, gun to my head, I think it's gonna. They kind of have to have a little bit of a hawkish cut here. That's what I think they're going to do. They're going to come in with a little bit more of a hawkish cut. I think they want to leave it data dependent because, like I said, they've been navigating in murky waters. The data void that we've had, causes some issues. So I think they kind of want to leave it as open as possible if you're thinking about it in a responsible way and not a political way.
Sure. Okay. Moving on, you got jobs, US JOLTS job openings. The labour data that we've seen, the one that we do get. Do you pay any attention to JOLTS? Do you think it adds any value to and just a deeper sort of picture to the overall labour market situation?
Yeah, I do. I mean, job openings, it's one of the inputs I use in kind of my labor market model that kind of just gives me an overview of how the labor market's evolving. But again, it's kind of the same thing today with PCE. Like this is going to be the JOLTS number from September, right? So it's going to be stale yet again, but I don't really see a reason for the downtrend to change much. But I do want to caveat that by saying, since November, we have seen a slight rise in the Indeed job posting index. And just to add a little bit more into that, like we spoke on Olio earlier, with Revelio Labs data that came out yesterday, job postings there declined by 30 basis points months over month for November. And, if we go back to kind of that data void we've been in without JOLTS, if you're relying on Revelio job openings, in September, the data showed job postings declined by about 0.7%. And in October, they fell by about 1.9%.
Okay, good to know. Okay, next up, Bank of Canada interest rate decision. Now, I wouldn't say they've mirrored what we've seen in the US, but do you think the economic situation in Canada will continue to deteriorate, or is it stalling now or the deterioration in as such, and it's on a more sure footing? Budget plans and everything else.
Yeah, I think it's starting to stabilize a little bit. I think a caveat in this, though, is still going to be trade policy, right? Because that's going to be a big driver. But if you look, GDP came in stronger than expected for Q3, right? It was at 2.6. Inflation is pretty much right around the target, or at least, within the bounds that the Bank of Canada likes. But I still think they got to remain a little cautious just because, demand domestically is very flat, and the ongoing trade uncertainties still pose some problems. And you look at the labor numbers that came out today. I mean, look, the drop in the unemployment rate was shocking, right? From previously was 6.9%. The survey was expecting 7%, came in at 6.5%, right? I mean, it was a huge move downwards in the unemployment rate. But with that, you also had the participation rate drop by 20 bips, and you had a fairly strong gain in part-time jobs, right? Full-time employment in Canada still printed negative, and a lot of those job gains in the part-time were just kind of from the service healthcare area. So like the report isn't as strong under the hood as it looks. So there's still some risk there. And I think the move that you saw in rates today is pretty much just maybe just unwinding some Canadian positions. Because to me, the data doesn't support, the 5 years up 16 basis points along with the 2-year on those moves this morning, right? Like those are just extremely large moves for if you break it down. The report isn't that strong. So I think there's still a lot of uncertainty, but I think also the Bank of Canada, they're in a good spot right now, right? They're at 2.25 on their overnight rate. So, they have some room here to kind of just stand pat and see what happens. I think they're in a better place than the Fed is right now. So I don't see why they don't just, continue to hold rates here and kind of see how the economy evolves. Now, what I think is a little off here as well is if you look at, kind of the swap market, they've actually started to price in some hikes into the Canadian curve in the latter part of next year, right? I think there's about 25 bips now. So a full hike priced into, I think, October of next year. Right. So I think that's a little premature.
Yeah, well, you have to. With trading futures, that's what we're there for, I guess, on that front. Okay, next up, UK monthly GDP. Now, we saw the budget last week, and it was fairly. I mean, the UK finance minister or Chancellor of the Exchequer, as we say domestically, leaked and trailed most of the budget ahead of time anyway. But what we did get really was a little bit of joy now with pain to come 2 to 3 years down the line. So there are tax rises to come. There is going to be some tightening of the belt, but it's not going to happen near term. She's paying that back in the back end of the forecast horizon. So from the UK, you mentioned the UK before and looking at the Bank of England and whatever, but just the UK in general. Are you not too hopeful then on the GDP? I mean, we're bouncing around the bottom at the moment. What 0.1, 0.2% growth rate? We're going to need to something.
Look, I mean, I think they're going to face a lot of headwinds from this fiscal consolidation, right? What did they say? It's going to be 26 billion in tax increases over the next 5 years. Was it?
Yeah, right? 2028, 29. Yeah.
Yeah, so it's just like I think GDP is going to continue to slow, right? I think they had it forecasted at what for this one? I think they had forecasted 1.4%.
They downgraded it by 0.5 percentage point, I think.
Okay, yeah, because I was going to say, 1.2% GDP growth, is probably being nice for 2026. And you look at inflation over there too, which is a problem. It's still kind of the highest in the G7 nations at 3.5%. So
that's not great. That's not saying a great deal, then, is it?
It's not, right? And like we just spoke about, the markets, they're pricing in a cut for the December 18th meeting, and that 1 year rate, which is pretty much like my proxy for, I'll call it, I guess, terminal for myself. It's right around 372 in the UK. So I think it's underpriced. I still think, the slowing of the economy is going to force them to have to cut rates a little more than that's priced. And, the economy is obviously going to lag behind Canada and probably, it's going to lag behind the US and probably even lag behind Canada as well on that front.
Well, just a quick note from the Q3 numbers. Output figures from the ONS, the Office for National Statistics, showed that growth slowed further in Q3 of the year, with both services and construction weaker than previous period. There was also further contraction in production, according to Liz McCowan of the ONS. She said production output plunged 2% in September, exceeding the predicted 0.2% decline, with the main drag was a nearly 29% fall in manufacturing of motor vehicles. Now, that was from Jaguar Land Rover, who were the victims of cyber attack, which closed their production lines for a period of time. So, I mean, there will be a bit of payback on that now that the lines have reopened and they can start, the lines again. So I'd expect a spike to come back into Q4, which will be misleading in itself, but will actually just balance out that decline from the fall in manufacturing. So we'll see how that plays out and how much of the, obviously services is the main output pillar for the UK economy. So, but we'll see what that brings in that respect. Okay, we got RBA rate decision coming up as well. They're likely to stay on hold, I think, for the near term. And then we've got mainland China CPI data as well to round off next week. Or I think it's in the middle of next week as well. We're coming to the end of the episode. I want to ask you a question about how you treat these last few weeks of the year. What do you do as someone who runs a portfolio? How do you manage the slowing or the reduced liquidity, reduced activity, and lower volatility that comes into the markets at this time of the year? What do you do generally?
So because I run a discretionary fund, it's very circumstantial, right? So it depends on how the year's going and what I see. Obviously, when you get into the second half of the month of December, it's very slow. But I got to tell you a story because I believe this was in 2000. This was 2018 or 2019. It was one of the first. For the first fund I worked for in Amsterdam, and I wasn't coming home for Christmas. My family was here in Canada. I stayed in Amsterdam, and it was Christmas Eve in Amsterdam on the 24th, and there was a sell-off in the market, a pretty drastic sell-off. And I remember sitting at my desk. It was just me and my boss there. And we were just buying the markets religiously on this dip. And we made a ton of money when the market bounced the next couple of days. So this has always been in the back of my head that I'm always kind of scared to get off my desk around the holidays because there is, some illiquidity. So things can happen. But for the most part, like if it's been a good year like it has this year, I just kind of try to pare down my risk a little bit. I'm not really looking at any speculative positions. I'm trying to, more gather my thoughts for the following year, how I think things are going to evolve, and just kind of lock in a good year.
Yeah, very sage. I would say that when I was trading back in the day, it was either feast or famine over these sort of periods. Either if you stayed sharp and you were alert, there was money to be made because there were gaps in the market and people were slow to react potentially. But again, the other side of it was if you were offside on a position, you'd have to sit there for hours trying to massage it and manage it and try and get yourself out with the least possible pain as an intraday trader as I was at the time.
Yeah, and I think it's also you got to weigh your mental capital too. This has not been an easy year.
No.
Right? So if you manage to, if you're happy with your year, there's nothing wrong in, kind of taking off that mental stress and kind of recovering into, it's going to be a fun year next year as well. That's kind of how I look at it too.
Yeah, I totally agree. And you have to manage yourself more than anything else. I mean, it sounds obvious, but you do as a trader, and you have to know your limitations and your capacities because it helps you understand how to treat the markets in any particular scenario. So yeah, good words. Sam, we're at the end of our time now, and I'd like to thank you for your participation today.
Of course, sir. It's always fun.
And just a little trailer. We are going to hear from you again because you'll join myself and Joseph Choi of the Curve Advisor this coming Wednesday to preview the FOMC interest rate decision, which should be a lovely discussion.
Yeah, that'll be lovely. If I don't freeze to death here in Canada, man, we're minus 24 degrees yesterday with the wind.
Well, you know what you signed up for when you lived there. So
yeah.
And I've been through one of those winters. They are harsh. It doesn't cover it. But again, driving in the wet, cold London, it's that's a different kind of cold. It's a different kind of cold. But again, thank you, Sam, and look forward to talking to you next week.
Of course, yeah, we'll speak then, Harry.
Yeah, and also thank you to everyone listening in to this episode of the show. Just know if you've missed the start of today's episode, you can listen back on X or on YouTube, or find us on podcast platforms such as Spotify, Apple, or Amazon Music, amongst other places. But thank you all for listening. Have a great weekend, and we'll see you again next week. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.